And hello once again, options traders. Welcome back, everyone. I wanted to touch a little bit on the specifics of gamma and why it's so important to watch, and probably even more important, how and why it changes. Because if you're not aware of that, you can step into some really bad traps, and it can also lead to some bad decisions. So let's take a look at how and why gamma changes and why it's important to understand. So first of all, for anyone who is not familiar with the Greeks, I do have individual videos in this forum on delta, gamma, theta, vega, and rho. So you might want to go back and review those first. But just for a quick review, recall that delta shows how sensitive your options price is to changes in the stock's price. So if we have a $100 call trading for 3, and our broker's platform says it has a delta of a half, or 0.5, you can think of that as 50%. That's what that means. And it means that it's going to pick up about 50% of that stock price change. So if your stock price rises right now from 100 to 101, that's a $1 increase. But your option's not going to pick up that full dollar, it's going to pick up delta, or 50% of that. So 50% of that dollar change is 50 cents. And that means your $100 call is going to rise from about $3 to $3.50. Now, once you understand delta, gamma is essentially the same concept. But what it does is it shows how quickly your deltas will change. Remember, all of your Greeks change all of the time. Yeah, there's a couple of exceptions when you're deep in the money, deep out of the money, or at expiration. But for the most part, they are always changing. So think about it. If your deltas change quickly, so can your profits or losses. And this is why it's key to understand. So here's how it happens, and here's how gamma generates your deltas and how they interact. I think most of you know that stock prices, at least stock price changes, follow a bell curve. And so let's say that this current bell curve that we're looking at here in blue is for 60 days until expiration. And as a side note, this is generated mathematically from the stock's volatility. But you don't need to understand that. You just need to know that stock prices basically follow this bell curve. So let's say that our current stock is trading for $100. A second important point is to understand that the current stock price always sits right at the center of that bell curve. And so maybe under this bell curve, let's say the stock might be able to rise up to 115, 15 points higher. And because it's symmetrical, maybe it can fall 15 points down to 85. So again, the key to understand right now is that the current stock price always sits right there at the top of that mound. So let's say that we also have the at-the-money strike of 100. So the current stock is right here at the center of the curve in blue, and let's put our strike here in red. So again, they line up, and that's because it's an at-the-money option. And what does that tell us? Well, what it shows us is that the stock price is equally likely to be either on the left or right-hand side of this red arrow. So let's say how much space or how much area is out here to the right of this curve. In other words, what are the chances for the option to be in the money? For that to happen, I need the stock price to be out here. It's got to be greater than 100. So because it's half of the area, I've shaded in half of this bell curve, our delta is going to be about a half. So if this stock rises again from 100 to 101, this option is going to pick up half of that, or about 50 cents. So let's assume the stock maybe rises out here to 105. Remember that current stock price is right there at the center of the curve. But our strike doesn't change, right? Once you buy a call option, or a put for that matter, those strike prices do not change. So where is 100 in relation to this curve? Well, it's way down here. So what's happening is that as that stock price moves up to the right, that bell curve is sliding further and further to the right, pushing this option deeper and deeper in the money. So now if you had to look at this, what are the chances that our strike stays in the money? Well, as before, all I'm going to do is take a look at how much of this area has been covered. So as this bell curve is moving to the right, effectively that arrow is getting pushed further to the left. So let's say that maybe now it's 60% of this bell curve is filled in. So my delta would be about 60% or 0.6. So if the stock price were to move $1 right now, I'm going to pick up about 60% or 60 cents of that move. And my option is becoming more sensitive because the option is becoming deeper in the money. Well, let's carry the argument out even further. Let's say the stock bumps up here to 110. Once again, it's right there at the center of that curve. But relatively speaking, our $100 strike is way down here. Now how much of that curve is filled in to the right? Well, now it might be 75% or 80%. So that means our deltas are now up around 75 or 80%. All right, let's carry the argument even to a bigger extreme. Let's say the stock goes way up to 130. So that stock is right there at the center, saying that it can move plus or minus within this bell curve, but our strike is way out here. So take a look at what the picture is telling you. No matter how high or how low the stock price might fall, it's going to be somewhere under that bell curve. In other words, it's always going to be in the money. This option can't fall out of the money. At least that's the perception of the market. And therefore, it's going to be trading like shares of stock and have a delta of 1. But here's the problem. Traders always assume that this blue curve here stays the same. They kind of sometimes get this idea that, yeah, the stock price moves up or down in relation to the strike, but they don't realize the shape of the curve is also changing. So let's say that instead of the stock price making these moves instantaneously, it took time. Instead of making all of these moves in virtually no time, let's say it took 45 days. So now we've got 15 days until expiration. Well, our curve no longer looks like this in blue. It now looks like this in red. It's very tall and skinny. So hopefully you can see what's happening. If we went through that same drill, in that same exercise, you could see that this red curve is going to get filled in much, much faster, and that means those deltas are a lot more sensitive. And if you're not aware of that, you can end up into some traps. So let's take a look at what can happen. So we're going to buy, let's say it's the at-the-money $100 call trading for $5. And to get this $5 price, I just put it in a pricing model with 60 days to expiration, 30% volatility, 2% interest. That's going to give us roughly a $5 option price. But now let's say that the stock price rises $10. So our stock is now at 110, but it didn't do it instantly like I assumed before. It now took 30 days. So now we have 30 days left until expiration. Our time has been cut in half. So now if you put this into a pricing model, you'll find that that $100 call is worth about $10.75. So if we paid $5 and we could sell it for $10.75, that's a $5.75 gain, or about 115%. So here's the trap. Traders look at this and they say, well, it took 30 days and a pretty good move in that stock price from 100 to 110 to get this $5.75 gain. And therefore, if it falls, it's going to come back on about that same path. And that is absolutely not true. And the reason is that the size of those bell curves is changing. That's what they miss. So unless the stock price falls quickly, it's going to probably fall a whole lot quicker than you expect. Because if it happens over time, that curve is now getting very tall and skinny. So let's say that the stock price falls only $5. Okay, we had it rise 10, but now we're going to just pull it back a little bit. So the stock is now at 105, but we're also going to cut the time in half again, from 30 days to another 15 days passing. So that means our option now has 15 days until expiration. And now if you put this into a pricing model, the $100 call is worth $5.81. It's only an 81-cent gain now, or 16%. So think about what happens. It took us 30 full days to generate a $5.75 gain, but it took only 15 days to nearly lose it all. And this is where traders sit there and scratch their head and go, well, what happened? How come it took so long to climb up to the top of the mountain, but then fell off? Well, you kind of answered your own question, because the mountain was getting much taller and much skinnier, i.e. that bell curve, as you got closer to expiration. So here's kind of what it looks like graphically. Let's say we bought our option for $5, and 30 days later, our options price climbed to a total of $10.75. But to do that, the stock price had to rise $10. But now we're going to advance the clock only 15 days. So that blue arrow there is only half the size of that red. So again, in your mind, it doesn't seem like it should be all that sensitive. But we're also going to cut the stock price change in half. Instead of assuming it rises 10, let's just assume that it falls only 5 in 15 days. So we've cut everything in half. From 30 days to 15, and the stock price changed from 10 to 5. But look what it did to our options price. It's going to go from 10.75 all the way down to 5.81. So you can see there's a much bigger difference in the steepness of how quickly that options price can fall. And of course, we could work it in reverse and say that it could rise that quickly too. Just depends on which side of that bell curve you're on. But the point to understand is that as the stock price moves and as time passes, the shape of that bell curve also changes. It gets taller and skinnier. And that means your deltas are becoming far more sensitive, and that means your options prices are becoming more sensitive. And this is why it's so important to understand some of the technicals, some of the hedging strategies, so you can protect those profits but still stay in the position. For those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsa2z.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.